Hi there, a very casual Mike Khouw just off the slopes in Park City, joined with my colleague Carter Worth in New York City. Of course, CNBC continues to cover the Beijing Winter Olympics and will through the end of this week. So we're going to be offering you this bonus coverage. Now, we promised yesterday that we would be taking some viewer questions. And I think this first one's pretty apt because we had a very volatile day today, obviously, as the concerns about Russia invading Ukraine went up again. This person is asking, Carter Worth, Options Action, Michael Khouw, do you think the SPY weekly chart is forming a head and shoulders? What does your eye see? Great stuff. Thanks. Carter?
Hi. See, this is live. It's all good. That's my mute button, and apologies. It's something that's an important circumstance. It's well observed, and you're right to inquire about it, or let's discuss it together. An uptrend doesn't just stop and then reverse and turn into a downtrend. It takes time and price to stall. And a head and shoulders is simply a reversal formation. It's well documented, has a lot of veracity throughout history. And what it is that you, in any uptrend, have dips, corrections, pullbacks. But then one of them, for instance, the one we make an all-time high in early January, it goes further than one would think and undercuts a prior intermediate low. And what we know is in the January sell-off, we went below the September low. And then you start to rally again, which we have, but you falter at or near the level of, in this case, the August-September intermediate peak. And so the original practitioners were desperate to, and this was all done by hand with paper and pencil, to discuss or make clear to those who didn't do it. So they named their patterns, cups and handles, heads and shoulders, that sort of a layperson could see. It doesn't matter what you call it. It's a reversal formation, and it's very much in effect. We have a break in trend. We have a head and shoulders. Now look at the Russell 3000. And here's the thing. We're going to try to toggle back and forth. So if we go back to the S&P, the S&P has that October-November high and makes a new high in January. Now look at the Russell 3000, a much broader index. You have a double top, which is to say it couldn't make a new high in January that was much above the November high. And it also is a head and shoulders. It's also a break in trend, and none of it's very good.
So, the interesting situation that we have here, of course, earnings are largely behind us, but we have two primary drivers for equities if we're looking at the S&P 500 right now. Obviously, the one that's at the forefront of everybody's mind is what is Putin going to do? What is going to happen between Russia and Ukraine? And the second, of course, is the Federal Reserve. We have the minutes that we got yesterday. We have Bullard's additional comments today. There are obviously some Fed governors that are getting increasingly hawkish. Is there a path for equities to go higher? Of course there is, but it's a Goldilocks scenario. We need obviously to see a resolution to the issues that we're seeing in Europe, and we also need to have a deliberate action by the Fed that is not going to spook the market. And when I take a look at this, that is one of several different scenarios that could happen, and we have to assume that the likelihood that we get that Goldilocks scenario is less than 50-50. So we had another tweet that came in, and actually we got several on this topic, on the topic of natural gas. So let's take a look. Craig asks, Carter Worth, Options Action, Michael Khouw, great job, guys. Can you take a look at natural gas? We are coming out of winter with a below normal amount in storage and wanted to discuss technicals. Now, where you get the information on how much is in storage is from the EIA reports, which, by the way, are released every Thursday at 10:30 Eastern. So the chart that you're looking at right now on your screen is actually the one that was released today. So the gray region depicts the high and the low amounts that we've seen in storage over the course of the last 5 years. The blue line is the lower 48 that you're dealing with, we're talking about in terms of the states, and then you can see also the average. But what we're getting to right now is we're right towards the bottom end of this range. We can see that year on year, we had a 404 billion cubic foot decline, and versus the 5-year average, we're about 251 billion cubic feet below the 5-year average with the numbers that were released today. Now, from a fundamental point of view, during the winter, obviously we produce less natural gas than we consume. If we start seeing colder weather and we have less in storage, that clearly would be extremely bullish for natural gas. Carter, what are you seeing in the charts?
Yeah, well, this is perhaps the most volatile of commodities, with the exception of orange juice, a very small commodity or that kind of thing. You have a freeze. Literally, nat gas is far and away, as opposed to oil or copper or gold, the most volatile. And you can see it here. This is a 10-year chart, and what, seven down to one or two, back to three, back to one, back to seven. No judgments, no lines. Let's put in some lines. Look at the next chart. And so fascinating. When we spiked in late 21, we went right to that 2013, early 14 high to the penny and backed away. And when we backed away, it held trend. You could see that. And then it thrust just higher there again, associated with prospectively the goings on in Europe. And now we're back to the trend line. I've drawn the green arrow because I think we hold here and then bounce again. Now, if we look at a next chart, it's another way to draw the lines, but it's an important double bottom. These formations are very real, 2016, 2020. But what about the all data chart? And here you can see, going back to the early 1990s, that nat gas came to life at a level which was at or near, quote, historic lows. And the coming to life was enough to cause the continuous contract to move above the downtrend line, in effect, since the all-time peak at 16 back in 2003, 2004. My hunch is it's right to be long. You don't need to be big in it because it's got all the leverage associated with futures. And even if you don't use the futures leverage, it has the leverage associated with the volatility that is natural gas.
Yeah, I mean, one of the interesting things, of course, that we have when we're dealing with natural gas, oil too, when we're dealing with North American production, obviously as the pandemic started to manifest, we had a huge surplus as demand really slackened, principally for oil. But what ends up happening as you start to reduce the amount of investment in the space, we start reducing the rig count and so on, you ultimately create supply shortages in the future. And I think that's what's starting to manifest here. So we can sort of understand what's going on. Also, kind of related to energy, we got a tweet about Generac. Now, Generac is a name that Carter and I discussed last December. We actually had a bullish trade on it that obviously did not work out very well because Generac got hard hit. Somebody was asking, options action at Michael Khouw and two others, Generac has tanked. My plan is to take delivery of the stock on February 18th and hope for an eventual recovery. Analysts have a target stock price much higher than where it is right now. After it begins to recover, I will sell 20 Delta calls against it. Thoughts on this strategy? Now, if we just take a quick look at some of the activity today, we did see some bullish call activity. This is kind of interesting because we saw some buyers of long-dated January 320 calls. Now, those were $51 a contract. So that's risking actually a pretty considerable portion of the current stock price. You'd need to see it rise considerably in a year to see profits. At 40 times earnings, you might not think it's particularly cheap, but it's actually growing 40% year on year. And what that tells us is that you get to a PEG ratio. This is something that when people are doing fundamental analysis and trying to see whether they're getting a good value, a PEG ratio of one is considered quite desirable. And as the question reminded us, the average analyst price target is substantially higher than the current stock price, more than 40% above the current stock price. The average analyst price target right now is $456 a share. They reported $2.30 in EPS on February 16th. The stock did rally sharply on that. So, Carter, what are the charts telling us about Generac at this point?
So the short-term chart first, and let's put then this in the context of the longer term. What do we know? You're talking about 500 down to 250, cut in half or worse. And then we've moved above this minor downtrend line in effect since November. And then we had a heavy volume upthrusted gap, volume not shown here, but you see that gap just 2 days ago. So consider this or keep this in your mind's eye, and let's look at the longer term chart. So a massive winner, right? And a well-defined trend, 100 to 500 plus, a break-in trend. And my thinking is at this point, based on the day-to-day action, and based on, if you look at the next chart, how far we've come down, 52%, that we're due for a bounce. And we're starting to see that day to day. And so while the December judgment has come and gone, and it was a bad one, I would be buying here.
It is really interesting. I mean, this is a name that the analysts, despite obviously being maybe a little bit overambitious over the course of the last couple of months, they really aren't shying away from the stock, and we have seen considerable relative strength in it. Now I think we're going to move over to a stock that was basically maybe the bellwether tech darling in 2000, and we're talking about Cisco. Donald Lipinski asks, my Cisco 60 call expiring March 18th is in the toilet, down 92%. What do I do with this? Well, we never like to hear that anything that we purchased is currently in the toilet. I think the trade you might be referring to, I'm not sure, but by memory, I think in January, Tony Zhang was talking about Cisco, and I believe he was talking about actually a 67.5 call spread. I don't know whether you put the call spread on. Obviously, selling the higher strike call would have mitigated the expense of that trade had you done it. But I think the question we can ask ourselves now is, given the fact that the stock has declined probably about 10% since then, what's the call? Taking a look at the options activity that we saw today, we did see a purchase of about 1,150 of the April 60 calls. Those were trading for about 72 cents. So somebody in the options market is making a bullish bet. But here's the thing I would just quickly tell people. Right now, the street's pretty tepid on this. We've got 14 buys, 17 holds. The average price target is only 12% higher than it is right now. And part of the reason for this is that the supply chain woes that the company has been facing aren't really expected to be lifted completely until 2023. There's still good demand. In fact, we saw a 33% increase in orders for Cisco, but still the street's only looking for 6% year-on-year revenue growth. That's reflective of the fact that they're still having supply problems. Orders are good, but you need to be able to meet them. Chartmaster, please tell us what we're seeing technically.
Well, so in my parlance, there's something called a pair of twos, and what that is think of what a really big hand is. A big hand is a flush, or a three of a kind, or a full house, or what have you. And we know that it's right to bet big when the situation, the opportunity is big. It's also right that if you have a modest hand, or a pair of twos, not even a pair of eights, the only thing worse than a pair of twos is 5 random cards. It's usually right to fold, i.e. to lose your ante and not put more money into it. So here's a one-year chart of Cisco. It has a high of Jan 2nd with the stock market. It sells off with the stock market. It's sort of just meandering here. It had a strong day today, but then more importantly, look at its all data chart, or at least going back to what matters. So just as Mike, you suggested or referred, Cisco is the most valuable company in the world. And here we are, 22 years later, and it's still below. So think about it. Now, does that mean it has to go down or up? No, it just, right here and now, there's nothing discernible. There's nothing particularly interesting. It's not particularly risky. It doesn't look as though it's got anything imminent to the upside. It's just a pair of twos.
And because it is not particularly risky, one of the things we do have in Cisco is that out-of-the-money call options aren't hugely expensive. I mean, given the market conditions in which we find ourselves, if you really feel compelled to make a bullish bet, maybe buying some longer-dated call options at or slightly out of the money is a way that you can make that bullish bet without committing a tremendous amount of capital. But just bear in mind that the fundamental issues that they're facing, things that were related to supply chain, aren't likely to resolve this week, this month, this quarter, and maybe not even by the end of the year. That's really looking out to 2023, and that might be one of the reasons why we would expect the stock to be stuck in the mud. So if you sent us a question and we didn't get answered, we did read all of them. We will try to get to those in a future video, perhaps even as soon as tomorrow. Please keep those questions coming, and we'll look forward to trying to answer them. Carter?
That's right. Tweet us, comment, and of course, if you want an alert when we post our next video, subscribe and hit the notification bell.